the nature of capitalism is that capitalism is creative destruction, and you know, there used to be only one company that was in the Dow about 90 years ago, that was in the Dow today, that was GE, and the one company is gone now. And like what I just saw in the paper is their new CEO has been unceremoniously been removed. So, I mean, GE was a pretty formidable company, and I think still in aircraft engines, etc., they have a pretty formidable moat. But you can see that even a company like GE basically is having a lot of difficulties. And so I think moats get filled in far more frequently and far more quickly than most of us would think they should get filled in. Um, and so your defense against that is the PE of one. So that's the only way to protect yourself. So the PE of ones are good for your health because you take your cash out after the first year, or maybe after a couple of years, and then you don't particularly care. You know, one of the things that I've been doing for the last few months is I set up uh, this waterproof Bluetooth speaker in my shower, and I listen to the Buffett and Munger annual meeting videos because they posted all the videos from '94 till last year on the I think the CNBC website, buffett.cnbc.com. And so I think now I'm at year 2001. I get through about half an hour a day, which is great. It's actually sometimes it's the most productive half hour of the day, I find. But one of the things Buffett was mentioning, I think in the late 90s, he was saying that I think this was in right at when the dot-com bubble was peaking. Maybe it was the year 2000 or 99. I think 99. Basically, he was saying that if you looked for companies that are making more than 200 million after tax in the United States, and this is, let's say, in the year 2000, um, there's like 400 of them. 400 companies in the US in around 2000 were making over 200 million after tax a year. And he said that the US at the time had been around for like 225 years or 224 years. And in 224 years of open capitalism with millions of companies, you ended up with just 400 companies that got to enough success to make 200 million a year. And I recently ran that number for today. So I said, let's change the 200 to like 500 because, you know, there's been all these years of inflation and expenses and all of that. And the number of companies today that make more than 500 million a year in the US is less than 500. And so the thing is that between 2000 and 2018, a huge number of businesses got formed, and there were a lot of businesses that were emerging at that time as well. And one of the reasons Buffett made that point was that he said that these companies making 200 million basically deserve, if they were going to continue making that money, probably deserved a market cap over 3 billion. You know, if you give it a 15 multiple or something. But the number of companies making over three, I mean, at that time, with a market cap over 3 billion, was many times that number. Was in the thousands. And part of it was at that time we had the dot-com bubble going on. I think he wanted to prove the point that a huge number of these companies are going to disappoint because they're not going to end up with those. They're never going to produce the 200 million to justify the 3 billion. And so even today, 18 more years have passed, and we've had all this tech and everything else that's happened, and the cloud, and you know all these things that have happened, and those numbers haven't changed that much. And so the bottom line is that if you're investing, betting on the future of these companies growing a lot, uh, you have to look at the other side, that not that many make it over the fence, and so the mortality rate is pretty high. And so there are 2 or 3 lessons from that. One is stick with the small and nano caps, okay? Because a lot of companies are basically in capitalism never going to get to 200 million or 400 million or 500 million. They're just never going to get there. They have a higher chance of getting to 10 million, 15 million, 20 million or something. That's a lot easier than 200 or 400 million. And the second is, take care of commandment number 4, focus on the PE of ones. So I think moats, uh, you have to approach moats with a jaundiced eye. I mean, if I go back to this company in Turkey, the cement company, so one of the issues that comes up in cement, and one of the reasons why it's such a terrible business in India, is there are limited barriers to entry. I mean, there are some barriers in the sense that in India, the limestone deposits are only in certain parts of the country. Um, Access to coal also is a little bit, it's not a given that you may have access to cheap coal or cheap power, but a lot of people can get past those 3 variables, and they'll definitely get past those 3 variables if you're making a lot of money. So even in Turkey, this company, I mean, the thing I have to think about is if they really get into great times. I mean, today I think the thing is the replacement cost, at which I questioned the CFO on, the replacement cost makes it prohibitive for them to put up new capacity. But at some point, if the numbers change, uh, then I'm not sure how strong those barriers are. They may be enduring for a while, or they may not. I just don't know right now. So I think the thing is that you have to recognize that people are constantly looking, it's just the nature of capitalism, to destroy your moat. They're just constantly looking to destroy your moat. And so what you really want to look for, and there are very few enduring moats. So you have to really look far and wide. One of the interesting thing about these enduring moats is many times the market doesn't price them any higher than the non-enduring moats. Sometimes market can't distinguish between enduring and non-enduring. And so if you can really identify an enduring moat, which are very few, and get into those, then life can be really good. But I think the PE of one is your protection against the illusional moats, if you will.